As I speak to you right now, the live trading session is underway, and Opendoor Technologies, ticker symbol OPEN, is trading at exactly $7.42 per share. We are seeing a pullback in today's intraday market movement, with the stock currently down approximately 2.11% from the opening bell. This follows a period of intense volatility, where we saw the stock test highs near $7.74 earlier in the session before selling pressure forced a retreat to current levels. When you look at the charts on your Fidelity mobile app or your interactive broker's trading screen, you are seeing a classic battle between profit-taking after a massive weekly run-up and new buyers trying to establish a support floor. The market capitalization is fluctuating right around the $7 billion mark, a figure that seemed impossible just 6 months ago when this company was being left for dead in the penny stock graveyard. The expectation from the general public and the average Wall Street analyst is that Opendoor is simply a digital house flipper trapped in a difficult macroeconomic environment. The prevailing narrative suggests that with interest rates where they are and housing inventory at historic lows, a company that relies on high-volume transaction velocity is destined to bleed cash until it eventually collapses. Investors opening their Schwab Intelligent portfolios might look at this sector and assume it is uninvestable, a remnant of the zero interest rate phenomenon that has no place in the current economic cycle. They see a company that just reported a net loss of $90 million in the third quarter and assume the business model is fundamentally broken. However, the reality is significantly more complex and arguably much more bullish than the headline numbers suggest. What we are witnessing is not the slow death of a house flipper, but the aggressive rebirth of a software logistics company. The recent appointment of Kaz Nejatian, the former COO of Shopify, as the new chief executive officer has shifted the internal operating system of this company entirely. This is no longer about buying houses. It is about founder mode. The reality is that Opendoor is undergoing a radical shift from a capital-heavy asset manager to a lean AI-driven liquidity provider. The market is beginning to wake up to this, which explains why the stock has rallied from lows of 51 cents earlier this year to the levels we see today. You are not looking at a real estate company. You are looking at a volatility arbitrage machine applied to the U.S. housing market. Let's break down exactly what is happening with the price action we are seeing on your Fidelity trading platform. The stock surged over 9% yesterday, and today's pullback to $7.42 is a healthy consolidation. When a stock moves this fast, up hundreds of percentage points from its 52-week low, volatility is the price of admission. This is not Apple stock where you can expect a steady, slow grind upward. This is closer to the early days of Tesla stock, where the market was deeply divided on whether the company was a fraud or the future of transportation. The volume we are seeing today is significant, indicating that institutional hands are rotating. We are seeing millions of shares change hands, suggesting that the smart money is starting to position itself for the next leg of this journey. The recent third quarter earnings report gives us the empirical evidence we need to understand this shift. Opendoor reported revenue of $915 million. Now, if you just look at the year-over-year decline, it looks bad. But if you look at the expectation versus reality, they beat the consensus estimates, which were pegged around $851 million. They generated more revenue than the street thought possible in this frozen housing market. This is the crucial disconnect. The expectation was that no one is selling homes to Opendoor. The reality is that desperate sellers are increasingly turning to Opendoor because the traditional market is too slow and uncertain. The company sold 2,568 homes in the quarter. While that is down from last year, the efficiency at which they are clearing this inventory is improving. When you manage your Fidelity investments or look at your SoFi investing dashboard, you have to look past the net loss. Yes, they lost $90 million. But look at the cash pile. They ended the quarter with $962 million in unrestricted cash and cash equivalents. This is a fortress balance sheet for a company of this size in a distress situation. This cash runway allows the new management team to execute their strategy without the immediate threat of insolvency that bears have been screaming about for 2 years. They're not running out of cash next week. This gives them the time to let the founder mode strategy take root. We need to talk about what founder mode actually means for a stock like this. It is not just a buzzword. It means stripping away the layers of middle management that plagued the company for years. It means treating every single home acquisition not as a gamble, but as a data point. The new CEO has explicitly stated that Opendoor is a software company, not a hedge fund waiting for the macro environment to improve. This is a massive distinction. A hedge fund bets on rates going down. A software company builds tools to make money regardless of where rates go. If you are using Robinhood stock trading to play this name, you need to understand that you are betting on the software efficiency, not just on the Federal Reserve cutting rates. The housing market in late 2025 is incredibly weird. We have rates that have stabilized but are still higher than the golden era of 2021. This has created a lock-in effect where homeowners don't want to sell because they don't want to trade a 3% mortgage for a 6% one. This destroys liquidity. In a normal market, this kills a company like Opendoor. But here's the contrarian take. In a market with zero liquidity, the provider of liquidity becomes king. If you absolutely have to move for a job, a divorce, a death in the family, you can't wait 6 months for a buyer. You go to Opendoor. They are becoming the market maker of last resort. This allows them to charge higher spreads and demand better terms. They are no longer chasing growth at all costs. They are chasing profitable unit economics. This brings us to the Robinhood app crowd versus the institutional giants like Fidelity Wealth Management. The retail sentiment on Opendoor has shifted from despair to euphoria and back to cautious optimism. We're seeing chatter across social platforms that rivals the enthusiasm for Nvidia stock, albeit on a much smaller, more speculative cap size. Retail investors are sensing a short squeeze, with a significant portion of the float sold short by hedge funds who believe the company is a zero. Any positive catalyst causes an explosive move to the upside. This is why we see these 9% and 10% daily moves. It's a tug of war between the old thesis, bankruptcy, and the new thesis, tech turnaround. Comment below how many shares of Opendoor you currently hold and what your average cost basis is. Are you holding from the highs of 2021, or did you catch the falling knife at 50 cents? Let's look at the operational changes. The company is aggressively managing its debt. They recently repurchased convertible notes, reducing their future liability. This is a sign of confidence. You don't buy back debt if you think you're going to need that cash to keep the lights on in 6 months. It's a signal to the Interactive Brokers trading community that the balance sheet is under control. Furthermore, they are expanding their partnership networks. By integrating with home builders and other real estate platforms, they are lowering their customer acquisition costs. In the past, they spent a fortune on ads. Now they are trying to intercept the seller at the point of decision through software integrations. The bear case, however, must be respected. We cannot gloss over the risks. If you are engaging in self-investing and managing your own individual brokerage account, risk management is paramount. The risk here is that the housing market takes another leg down. If home prices drop 10% nationally in 2026, Opendoor's inventory book, even though it's smaller than it used to be, will take a hit. They are holding hundreds of millions of dollars in homes. A devaluation of those assets wipes out equity. Additionally, the software transition carries execution risk. It's easy to say you're becoming a tech company. It's hard to actually do it when your underlying asset is physical piles of wood and concrete. But let's return to the price action we are seeing today at $7.42. The support levels are forming around the $7 mark. If the stock can hold this level, technical analysts on trading platforms like Interactive Brokers platform will view this as a higher low, a bullish setup for a breakout toward $9 and eventually the psychological $10 barrier. The moving averages are beginning to curl upward, and the momentum indicators, while overheated, are resetting nicely with today's pullback. The comparison to SoFi stocks or SoFi ETFs is interesting here. SoFi also went through a period where the market punished it for being a bank when it wanted to be a tech platform. It took years for the multiple to expand. Opendoor is in the early innings of that same fight. They want a tech multiple, not a real estate multiple.